to emerging markets, shall we? Which my next guest says don't have an inflation or growth problem. They have a Fed problem. He argues that non-recessionary cuts here in the U.S. will open up some much-needed capital flows. Joining me now is Pramol Dhawan, the head of emerging markets portfolio management at PIMCO. Pramol, it's great to have you here. Welcome.
Thanks for having me, Kelly.
So what exactly do you mean about the risks here coming from the Fed? Explain how this all plays out.
All right. For emerging markets, we've really had a torrid time over the last 5 years. We've been hit by successive shocks from COVID to wars in Ukraine and the Middle East. But more recently, the tightening of financial conditions, particularly in the U.S., has been one of the major concerns for emerging markets. Effectively, what it does, Kelly, is it sucks capital away from the emerging markets and into the U.S. and in U.S. money markets. So it sort of stands to reason that if we think we're on the precipice of non-recessionary rate cuts in the U.S., some of those capital flows can start to reverse, and that can be a boon for emerging market policymakers.
Yeah, so they always, with emerging markets, it's a little bit of a boom and bust type of cycle. Which ones now do you think you could own and kind of experience some exciting returns? Well, maybe exciting, the right kind of exciting, not the wrong kind.
So when we look across various emerging market middle-income countries, we think that there are a certain subset of countries where the policy rates are just too high for domestic cyclical conditions. Countries like Mexico and Brazil, South Africa and Peru in particular, have effectively been waiting like a deer in the headlights for the Federal Reserve to start their cutting cycles. And when they start to normalize, then it allows these countries to fine-tune their own monetary policy to bring their domestic conditions back down to some cyclical realities that they have. We also take a look at a country like Turkey, which is Cyprus at the moment, where the monetary and fiscal framework has changed versus where it was 5 years ago to really tight monetary conditions, tight fiscal conditions, and we're starting to see impacts of declining inflation based on that tightness of financial conditions there.
Yeah, and so I think people are wondering, okay, if all these dislocations present an attractive entry point, is there an interesting trade to be made here? We've heard bullish commentary about India. We've heard a lot of caution about China. Maybe there's opportunity in Mexico. Maybe all of these consensus ideas are already priced in. What do you think?
Yeah, I think a lot of them are priced in, and I think a lot of the volatility in the last few weeks was a sign of that, where it wasn't really predicated on fundamental weakness in the underlying economy, but more that these carry trades had been overly subscribed. And we've seen quite a substantial amount of deleveraging from those carry trades, and it allows active managers to really go on the front foot now. And we've been looking to add back some of these high conviction ideas. But I do think over time, as the Federal Reserve does normalize policy, you're going to start to see that capital flow make its way to EM economies. And emerging markets has really been a little bit of a forgotten asset class, Kelly. It's been heavily underallocated too. And it only takes the stabilization of those flows to start realizing some of those high yields and the carry that's embedded in these currencies.